The stock market can feel like this super exclusive club, right? Like you need a secret password to get in. Well, today we are kicking down that door. We're going to make this so simple, you'll wonder what all the fuss was about. Let's get right into it.
Okay, so forget all those crazy charts, the complicated jargon. None of that. To really get what the stock market is all about, all you need to picture is a lemonade stand. Seriously. This one little stand is going to teach us pretty much everything we need to know.
All right, so picture this. You and 3 of your best friends decide you're going to start the best lemonade stand in the entire neighborhood. I mean, you've got the secret family recipe, you're ready to go, but there's just one problem. You need some cash to actually get it off the ground. So you all sit down, you run the numbers, and it turns out you need exactly 1,000 rupees. That's going to cover everything, right? The lemons, the sugar, all the cups, even a decent table to put it all on. That's your startup cost, 1,000 bucks. So what's the plan for the money? Simple. You and your 3 friends, you each put in 250 rupees. Easy peasy. And just like that, you're all equal partners. Each of you owns exactly 25% of the business. And that idea right there, that little piece of ownership, that is the key to this whole thing.
You know that 25% piece of the lemonade stand you own? Well, in the big, fancy world of finance, there's a name for that. It's called a stock, or a share. It's the same thing. So next time you hear someone say they own stock in, say, Reliance or Infosys, all it means is they own a tiny piece of that huge company, just like you own a piece of your lemonade stand. See? Not so complicated, right?
And what do you know? Your lemonade stand is a massive success. It's incredible. There are lines wrapped around the block. People can't get enough. And you start thinking, man, if we're doing this well here, imagine if we had stands in 5 other neighborhoods. The light bulb goes off. It is time to grow. But then, you hit your next big problem. To open 5 more stands, you're going to need 5,000 rupees. And let's be real, you and your friends don't just have that kind of cash sitting around. So, what do? This is the classic question, right? How does a small business get that big chunk of money it needs to expand? And here's the brilliant solution. You decide to sell off tiny little pieces of your lemonade empire to other people, to the public. Now, you're not borrowing money from them. This is different. You're offering them a chance to become owners alongside you. They give you the cash you need, and in return, they get to own a small slice of the company and share in the future profits. So this huge moment when a private company, like your lemonade stand, offers up its shares to the public for the very first time, that has a special name. It's called an IPO, which stands for Initial Public Offering. You've definitely heard of these, right? Like the big IPOs for companies like Zomato or LIC. All that is a giant company doing exactly what you just did with your lemonade stand, raising money to get bigger by letting the public buy in. Okay, great. So now you've got hundreds of new part owners. But what happens next? What if, next Tuesday, one of them wants to sell their piece and someone else wants to buy it? You can't have them all calling you directly, right? That would be chaos. You need some kind of organized place, a marketplace, for all this buying and selling to happen smoothly. And surprise, surprise, that is exactly what the stock market is. Honestly, the best way to think about it is like a huge vegetable market. You've got people there selling their veggies, which in this case are their shares, and you've got other people there looking to buy. The stock market is just that giant, organized place where buyers and sellers of company ownership can meet up and make a deal. So, in this market, you've basically got 4 key players. First, you have the sellers. These are the people who own shares and want to sell them. Then you have the buyers, the ones who want to get in on the action. You've got the platform itself. That's the actual marketplace, like the NSE or BSE here in India. And finally, you have the middleman. This is your broker, like a Zerodha or Grow, who helps you, the individual, actually place your buy and sell orders on the platform. Okay, but here's the million-dollar question, isn't it? Why do the prices change every single day? Like, if you bought a share of your lemonade stand for 10 rupees, how is it suddenly worth 12 rupees tomorrow, and then maybe only 9 the day after? Well, the answer, believe it or not, goes right back to that lemonade stand. It all comes down to one word: demand. Okay, let's go back to the stand. It's the middle of summer, it's scorching hot, and your lemonade is flying off the table. Business is absolutely booming. Everybody sees this, and they all want a piece of it. So now you've got way more people wanting to buy a share than people who want to sell. What happens? People are willing to pay a little extra to get their hands on one. High demand, high price. Simple. Now let's flip that completely. Imagine it's the dead of winter, it's cold, it's miserable, and nobody is buying lemonade. Profits have tanked. So a bunch of your existing owners get a little nervous, and they think, hey, maybe I should sell my share. But who wants to buy a piece of a struggling lemonade stand in winter? Now you have more sellers than buyers. To get a deal done, the sellers have to drop their price. Low demand, low price.
And this, right here, is probably the most important thing to understand. A stock's price isn't some magic number calculated in a lab. It's not just what the company's desks and chairs are worth. It is a snapshot of public opinion. It's what millions of people collectively think the company is going to be worth in the future. It's based on profits, sure, but also on news, rumors, and sometimes just plain old feelings.
Okay, so we've got a handle on what a stock is and why the prices bounce around. But let's get down to brass tacks. How do you actually make money from all this as an investor? Well, there are basically two main ways. First up, the one everybody thinks of, capital gains. It's the classic buy low, sell high. You buy a share for, say, 100 rupees. The company does great. The price climbs to 150. You sell. That 50 rupee difference, that's your profit. The second way is something called dividends. This is kind of cool. When the company has a really good year and makes a lot of profit, it might decide to share a little piece of that profit with all its owners. It's like a cash bonus, a little thank you for being an investor.
But, and this is a big but, we have to talk about the other side of this. We have to talk about risk. Because this is not a guaranteed win. Just as easily as prices can go up, they can, and they do, go down. You might buy that share for 1,000 rupees, some bad news hits the company, and suddenly it's only worth 800. If you sell at that point, you've lost 200 rupees. That's the deal. That is the risk you take for the chance of that reward. So you're thinking, okay, I get it, I'm ready to go. But then you open up a trading app and see there are like over 5,000 companies listed just in India. How on earth are you supposed to pick the right one? It's really, really tough. And if you bet on the wrong company, well, you can lose your money. But there is a pretty smart shortcut.
I love this analogy because it makes it so clear. Buying a single stock is like putting all your money on one horse to win a race. It might win big, or it might not even finish. An index fund, though, is like betting a small amount on all the top horses in that race. You're not trying to pick the single winner. You're just betting that as a group, the best horses will do well. It's all about spreading out your risk. And we have these right here in India. You've probably heard of the Nifty 50. That's an index fund that just buys a piece of the 50 biggest companies on the National Stock Exchange. Then there's the Sensex, which does the same for the top 30 on the Bombay Stock Exchange. The cool part is, by buying just one share of a Nifty 50 fund, you instantly own a tiny sliver of all 50 of India's top companies. It's a much simpler and often a much safer way to get started. So look, if you walk away from this with just one thing, let it be this. A stock, it's just ownership. The market, it's just the marketplace. And the price, it's all about what people want. It's about demand. That's it. That's the whole game in one sentence. And you know what? Understanding all of this, this is actually the easy part. The really, really hard part of investing has nothing to do with the math. It's all about what's going on up here in your head. When the market is flying high and everyone's making money, can you control that feeling of greed? And more importantly, when everything is crashing and it feels like the world is ending, can you control your fear? How you answer those two questions, well, that's what will really determine if you succeed.